Okay, let's talk briefly about what's called currency arbitrage or triangular arbitrage, and we'll build on this going into the next chapter when we talk about the parity conditions for foreign exchange pricing. Triangular arbitrage in particular, you think about a triangle, you've got three things, or three sides or 3 points, and here we're talking about three currency pairs, specifically the dollar to a foreign currency, to a third currency, and then back to dollars. So there's three currencies we're talking about. And arbitrage refers to finding a surefire profit opportunity based on buying an asset or a good where it's underpriced and then selling it where it's overpriced. And what a lot of foreign currency traders will do is look for discrepancies in exchange rates. And a discrepancy in an exchange rate will mean that they could buy the currency where it's relatively cheaper and then sell it where it's relatively more expensive and then possibly earn the spread or the difference on those exchange rates. That's if the cross exchange rate is not in alignment with the implied cross exchange rate. Now we'll work through some math on that here momentarily. If you find a true arbitrage opportunity, it can become a zero risk, zero investment strategy, meaning you don't have to put any money out, you don't have to commit any money, and it's a surefire thing. Now that's caution is in order because especially in foreign currency markets, there's a good chance that somebody else has seen the arbitrage opportunity and might take it before you can execute your trade. And then in that case, there will be some risk of loss, or at least not earning the profit you thought was there. Okay, now here's an example of a triangular arbitrage opportunity from our book. It says, you are a trader monitoring the foreign exchange market on Wednesday, April 3rd, 2019. That's where we had that chart of foreign exchange rates that we looked at earlier. You have $1 million to trade. We're ignoring the bid-ask spread and transaction costs. That adds a little complication, but the essence of what's going on will be the same. You see that Credit Suisse and JP Morgan are making a market in Swiss francs and Japanese yen against the US dollar. And they're quoting the dollar Swiss franc and the yen dollar rates, the same as those listed in the table. You also notice that Mizuho Bank, a major Japanese bank, is making a direct market between Swiss franc and Japanese yen at 112.2 yen per Swiss franc. Whereas the implied cross rate between the Japanese yen and the Swiss franc was 111.69, and that is confirmed here when we look in the cross rate table. So what does that mean? Well, that means Mizuho is paying you a little bit too much yen per Swiss franc. It's paying more than the other people are. So you can see the arbitrage opportunity. If you can go to JP Morgan and buy yen from them at 111 yen per Swiss franc, you can then go to Mizuho and sell those yen at 112 per Swiss franc. Well, in order to do that, though, you've got to convert your dollars to Swiss francs first. And you can do that at this price here, 1.0018 dollars per Swiss franc. All right, so the chart here kind of summarizes that entire trade. So you're going to start by transferring your dollars to Swiss francs at that rate of 1.0018 dollars per Swiss franc. So that leaves you with just a little bit under 1 million Swiss francs. Now you take those Swiss francs and you sell them to Mizuho, where they were offering too much yen per Swiss franc, because remember their yen for Swiss franc was a little bit higher than the market rate right here. So they're going to give you a little bit of extra yen per Swiss franc, so you're going to take that offer from them. So you're going to convert your Swiss franc into yen. You're going to end up with, what is this, almost 112 million yen. Now take your yen back to the what we'll call the market price here of 111.49 and convert them back into dollars. So you divide the about 112 million yen by the yen per dollar price of 111.49, and that gets you $1.004 million, or $1,004,560. So see how the profit pans out there. You started with $1 million, you end up with $1,004,560. Your arbitrage profit in this case is $4,560. Now there might be some transactions costs based on the difference in the bid-ask spread, so you might not be able to make $4,560, but if you can do the math and realize that even after incorporating the bid-ask spread, there's still potentially some profit on the table. So what's going to happen? Well, as more traders see this opportunity, what they're going to do is bid up the demand for Swiss francs in this step of the transaction, so going from dollars to Swiss francs. So that's going to make Swiss francs a little bit more expensive in terms of dollars. That means you won't receive quite as many Swiss francs here. Then they're also going to offer more Swiss francs for yen at Mizuho, which is going to make the yen price of Swiss francs go down a little bit. There's going to be a little extra supply of Swiss francs coming into Mizuho in the yen to Swiss franc market. So that'll make that price fall. And it's probably going to quickly collapse back to the market price that's being offered by the other traders before many people will have a chance to make this arbitrage profit. In fact, if you read the textbook, they say that most of these kind of arbitrage opportunities they go away within minutes, if not seconds, because there's so many traders every day monitoring these markets, and most of them also will have computer programs set up where if there is a discrepancy like this, it'll instantly alert them to the profit opportunity. So they'll be exploited almost as soon as they appear. Okay, so there's a little bit of kind of like inside baseball on foreign exchange markets.